Greetings, Jonathan Camarda. Hopefully everyone's doing well. A little bit of a chill in the air. Will that chill invigorate stocks? Let's find out. So first, starting off from an economic standpoint, we saw a little bit tick up in inflation last week. CPI, PPI data coming in a little higher. Interest rates, of course, remaining sticky. Still have that inverted yield curve, 2s versus 10, and a 2 to 10 ratio there. Although with the geopolitical risk, which we're going to get to very briefly here, you saw a little bit of running into treasuries. So I do watch that dynamic in some of our strategies where we're short the longer term treasury end of the yield curve and long interest rates, so to speak. But you have to look at the duration in which investors are moving money into and as such. So that's one dynamic that we are watching. Now, speaking of the geopolitical risk, obviously this conflict in a few places now had the horrific situation, which I'm not going to go into any detail. You can see enough of that in the news. But how does it affect the money? Well, historically, you would think equity markets are rattled by such things, but they have not been. Of course, we have to watch to see how this materializes, as some large institutional CIOs have come out and spoken, but they usually do. And, who knows on the accuracy ratio of what they say and the actual outcomes, as nobody seems to report on that. They should do a metric. Like Bill Parcells used to say, you are who your record says you are. All right, now as we go down, my hit list for mid-October, next thing I'm looking at as well is, interestingly, as credit starts to tighten, right? We talked about this. We started foreshadowing, especially in March with some of the regional banks. But on a larger level, credit is tightening, corporate bankruptcies going higher, and we are definitely watching that as well. And you start to see that as, again, we start to move into more of a recessionary cycle, which, again, everyone's been calling for the big bad wolf. The little boy that cried wolf, not here yet. You never know when it's going to be at the door. Hard landing, soft landing. It's like a Taco Bell question. Who knows at this point? However, we are watching that pretty closely as well. As money becomes restricted, things become a little bit more difficult. And again, we believe also that, with the underperformance of small caps, that you definitely, who need the money, by the way, to borrow, right? They don't have the big bourses on the balance sheets. We personally believe, myself, as we look across the landscape, that also is providing a dampener on your smaller companies in need of cash versus the larger corporations. Now, as we move across the spectrum and look beyond that, the stock market's kind of in a sideways pattern. Now, interestingly enough, the NASDAQ, of course, all year long has been the leader, and it is right now. Technically, the NASDAQ above the 50 and the 200-day moving averages. And the S&P, kind of like the three little bears here, is between just below the 50-day moving average, trying to nudge above, has not been able to yet, above the 200, while the Dow Jones, all right, the coldest of the porridges year to date, certainly. A lot of these value stocks you see, I'm not going to name the names, household goods, you see these down big this year, right? Big, after being resilient last year. And so essentially the Dow just popped above the 200, but well below its 50-day moving average. So what does all this mean? Well, it looks like the larger tech companies, again, the big seven, which has driven the market returns this year. If you look at most stocks, they're not up as much as the S&P 500. In fact, a lot of them are down, but the big seven have been carrying that weight. Continues to be the case even recently, as well as year to date. So we'll see how that progresses. The way we're positioned is to take advantage of that. However, again, in moderation and strokes of grace, so to speak, because, again, nothing is binary. As we look at the market, turning back the pages to 2021, the market is right where it was July 16th of 2021, just to show you last year's drop and really it's been a market going nowhere from that standpoint. Now, as we mentioned, we're entering a seasonally strong time of year, right? And there's a lot of money on the sidelines. A lot of overhangs, right? The bears want to talk about inflation's persistent. The Fed's going to lift again in November. And, of course, a geopolitical backdrop is unknown. It could be, we could have disasters or it could recede depending on how things go. That being said, right now we are, again, neutral and deployed the way we have been because we don't want to take anything for granted. As you roll through your quarterly statements, obviously Q3 not as pretty as Q2. As your personal wealth advisors review that with you, and obviously clients that I've spoken to and left messages, kind of giving that backdrop to you. We'll see what Q4 brings. Again, eternally vigilant. keeping our foot near that brake pedal, but certainly don't want to take it fully off the accelerator at this point. So many dominoes could go different ways, and certainly don't want to pretend like some of the folks smarter than us where we know things are going. That being said, earnings season starting. Had a good start, very, very slight start. It's only 6% of companies reported most of the financials. They all look surprisingly pretty good. Net interest income, net interest margin, not to go crazy, what that actually means is that the money that they're charging out there is exceeding what they're having to pay out in deposits and such, so it's been positive. We'll see. We're in the top of the first inning on earnings. Next call we do here, we'll kind of unfold, unwrap, unpack all of that for you. Well, like I said, it's getting a little chilly. Keep the kids extra warm, grandkids. Holiday season is almost upon us, and hopefully the fireplace and that Yule log continues to burn higher for stocks, but we shall see. Till next time, Jonathan Camarda. Stay eternally vigilant. That's what we'll do. You know what to do. Stay frosty. Not as hard to do as it is in the summer. Ciao.